Every day, millions of shares or equities are traded on the world stock markets, from New York to London to Shanghai. In 2015 alone, an amazing 23 billion shares were traded globally, with a value of $114 trillion. Professional fund managers, as opposed to individual investors, make 85% of these trades. When a company first issues shares to the public, the resulting funds are used by the business to finance growth and development. These shares are then traded on the stock market, a secondary market, enabling the original purchaser to sell them on and others to buy them. Businesses whose shares are available for sale on an official stock exchange are called listed companies. The FTSE 100 index is a measure of the shares of the largest 100 companies of over 2,000 that are listed on the London Stock Exchange. Similar indices exist in other countries, for example the S&P 500, which comprises shares listed on the New York Stock Exchange. But how does the market decide what the shares are worth? One way of looking at markets is to think of them as a very powerful computer, processing all known information about companies and incorporating it into the price of shares. No one person can know if a share price is correct or whether it is undervalued or overvalued. But because the price reflects all the known information about the company, it is what millions of traders at any one time believe is the fair price. Just like everything else, share prices are affected by the dynamics of supply and demand. We all know that some things cost more when there is a greater demand for them and less when fewer people want them. We accept that the price we pay for goods and services is fair and then make a choice whether we buy them or not. It is the same with stocks and shares. Of course, there are some people who think they know better and can spot mispriced shares or predict when prices will go up and down. They're like people who constantly change lanes in heavy motorway traffic. They rarely arrive any sooner than the rest of us who stay in lane. All investment managers, the people who decide what shares to buy and sell, have access to the same information. So markets work because they already incorporate everything everyone knows about all the companies in the market. This is known as the efficient market hypothesis. Active investors, those who believe they know something the rest of the market doesn't, are the ones that actually drive the market by frequent trading. But they often miss out on the steady gains that are made by adopting a buy and hold strategy.